to my phone. It is now 12:05. So, welcome to Broker Chat. I'm Tom Fulkerson. I'm your qualifying broker for the Heart of Atlanta Group, and we appreciate you taking the time to join us today. I asked Krishen Shah, Krishen, uh, to join us today from Highland Mortgage to give us an update on rates, new programs, things that might help you with your strategies when developing contracts for your buyers. So, without further ado, Mr. Shaw, you have the floor.
Well, thank you, Tom. I really appreciate it. I always love getting to come on here and chat with you all. It's always nice to chat with all the agents at the Heart of Atlanta, and also get some feedback on what you guys are seeing on your end as well. So, ton of stuff going on in the market, right? So with rates, let's go ahead and dive into that. I think I probably get asked what is going on in the market with rates essentially every day. And you would think that we might get a little frustrated, or I don't want to say annoyed by it, but it's a question that has to be asked every day, because every day is really a new day in this market. And each day kind of has its own narrative. And I think that over the past few weeks, there's just been a ton of volatility, right? So what we've seen in the past couple of weeks, right, with this whole debt ceiling stuff, with trying to get onto the same page, our government trying to get on the same, our Congress and the White House trying to get on the same page and get a debt ceiling signed. So during that period of a bit of uncertainty, we saw rates really climb back above 7%, which really kind of put us back into the October, November of last year period where rates had really peaked. I mean, inflation was at its highest, and we saw rates get at about 7% there. We saw them go back there just a couple of weeks ago. Really, actually, at the beginning of last week, they were still there. Of course, when the House chamber, when the Speaker of the House, McCarthy, came to an agreement with President Biden, we did get a ton of reprieve, which was a great thing to see. And then, of course, when the Senate signed off on it, and ultimately Biden signing it over the weekend, I believe it was Friday evening that he signed it, we did get some reprieve. Now, that was great news. That is fantastic news. But what the Fed has been saying all along is that they are planning to keep rates. They wanted to keep rates rising or keep them steady until they get back to their magic figure of 2%, right? That's been the term that they've been trying to get to, which was 2%. And really, over the past few months, the narrative has kind of changed. What they are trying to do now is they would like to really see the labor markets go through, quite honestly, a little bit of pain. Right now, inflation is actually going back to where they would like for it to be. I mean, last month when the CPI report came out, we were under 5% for the first time since really the middle of 2021. So we are really going back into that realm. And then you keep asking yourself, at least I do, is why are rates still hovering around that upper 6%, close to 7% mark? And really what happens is they are trying to make sure that unemployment goes up. And if unemployment goes up, if there are more pain given to the labor markets, that's ultimately what they think is the final tally to getting inflation down. Because right now there are just there's too much money being spent on too few goods. It's kind of what the definition of inflation is there's too much money being spent on too few goods. And quite honestly, there are still that's still what's occurring. And the way that the Fed would love to see inflation come down even further is by bringing a little bit more pain to the labor markets. And if unemployment goes up a little bit higher, there's going to be a lot less spending going on in our markets because of that. One thing that we will be seeing soon, based on my prediction, is one of the things that were agreed upon in the debt ceiling was the student loans. Student loans will be going back in to mandatory payments. And so we were at the time that they will be going back. I believe they're eyeing September. So beginning of September. So we have about 90 days until that goes back into effect, until folks will be mandatorily required to make those payments. So with that being said, there will be naturally less spending on other goods because folks will have to accumulate dollars to make sure that they are making those payments on student loans. So at that point, we'll be right at about 3.5 years of folks not having to be required to make their student loan payments. And so when that occurs, we do predict that there will be a lot less money spent on, whatever it is folks are spending money on, luxury goods, eating out, things like that. So we'll have to kind of start seeing how that affects the markets. Of course, we probably won't really see the true effects of it until, definitely into Q4 of this year. And we just start taking it day by day at this point. We're at about a flat market this morning, and next week will be a big week where we get our consumer price index report that comes in, which is the greatest measurement, the Fed's favorite measurement of measuring inflation. So as that comes in on June 13th next week, that will be the May report of how inflation has gone on. And if you might remember that June of last year is technically where we really peaked. So you get June's report in July, and last July, that was when inflation had hit 9.1%. So we're predicted to have about half of that by the time we circle back 12 months later into this year, which is going to be great news. So I think that, we just have to keep our foot steady on the pedal and make sure that inflation is coming down. And ultimately, I think that the Fed will have no choice but to lower interest rates, as they're not really going to have much else of a reason to hold rates where they are right now. So that is where the market is currently. We're still mid sixes, upper sixes right now in terms of rates, but definitely no shortage of homes being sold out there. It seems like I'm still seeing a ton of stuff go a little bit above list price, multiple offer situation. Obviously, I'd love to hear agents on the call. I'd love to hear your feedback there and what you are seeing as well. But that's kind of what I have on the market and where rates are right now. Of course, Tom, I don't know if this is a good moment for me to kind of pause and see if there are any questions or any feedback in terms of that before I go into what I'm seeing in terms of loan programs.
Sure, go ahead. Anybody have a question or a comment so far?
I do. What's a flat market?
I'm sorry, say that again.
Well, you mentioned that we're in a flat market. What can
Oh,
you?
Yeah. That just means that there's no market movement in terms of rates today. So where the market closed on Friday, we're essentially right there currently today. We did see a little bit of fluctuation before the market technically opened, and then it went back to a flat market so far. But in these days, a flat market is not a bad day, so we'll take it. And at least it's not going up.
What would you advise if you're an agent writing an offer right now on a conventional loan exhibit? What would the rate be that you would need to fill out on your form to present to a seller?
Yeah, no, great question. A question that we definitely get quite often. It's always dependent upon down payment and credit scores. Those are going to be the two major factors there. And it's a good segue into me going into what agents are seeing on y'all's end, more or less conventional and FHA. And I'll let you know exactly what I'm seeing. But right now, Tom, if you're looking at a conventional loan offer, let's just say your client's putting 10% down, they have a credit score in the 750s, you're probably going to be in the mid sixes. That's likely with a little bit of a discount or origination point. Those two terms are kind of used interchangeably. But you're right at about 6.5. If you're looking at just a par rate, wouldn't be that they are not paying any discount or any origination. You're probably going to be looking at about 6 3/4. Again, a ton of different kind of programs out there, dependent upon what your clients, what their situation is, where their credit scores are, down payment, etc. That kind of segues me into my next topic of the differences, the pros and cons between conventional and FHA, and what you as agents are seeing a little bit more often. I know definitely and wholeheartedly on my end, I'm seeing a lot more FHA options, as it's just a better benefit for the clients right now, especially if you aren't putting down 20% and you're going to have some mortgage insurance already included into there. I've presented this definitely at our team meets in our Metro Atlanta office for sure, about how FHA has strengthened their loan program a ton this year by lowering their mortgage insurance premium almost half of what it was before. And their rates are significantly better, as well as Fannie and Freddie has adjusted their what we call loan level price adjustments. So they have put a little bit harsher or maybe stricter penalties on folks who don't have fantastic credit or are not putting down a great deal of money. So if you have clients in that aspect, definitely ask your lender, hey, what about an FHA product?
Okay, so if I'm a buyer's agent, how am I going to explain that to a listing agent? And if I'm a listing agent, how am I going to explain that to a seller? Because I feel like sometimes there's a stigma around FHA versus conventional, and I'd like to address that with this group.
Yeah, no, great point, great question. It's something that I chat with my agents about all the time, and I always say, if the way that I try to present it to, if I'm speaking to one of my agents about a buyer that they sent me, the way that I present it is, hey, John Smith can go conventional, totally can go conventional. He is very qualified. He can go conventional. But if we are looking out for the best interest of the buyer, especially right now, knowing that every client is purchasing right now or in the past 12 months or going forward in the next 6 months, they will be able to refinance. If we're looking out for their monthly payment, their funds, it's going to be a better benefit for them to go FHA. Now, if you are explaining and that's kind of how I would ask an agent to maybe explain it to a listing agent. Hey, we can go conventional if that is what your seller prefers. However, if the option is available, we'd like to go FHA. Now, understand that could be a little bit different when you're talking about a condo or a townhome, as those need to really be actually approved via FHA. But if you're looking at a single family home, or if the seller doesn't have any sort of issue with what program they go with, as long as they're, through underwriting and kind of, it's still a strong offer, definitely good to present the option of possibly being able to go FHA if you're speaking to a listing agent.
Awesome. Everybody understand that? Susan, you've got your hand up.
Yeah, so I always thought FHA was more for people that have buyers that have low credit scores and high debt to income ratios, but it doesn't sound like that's really the case.
Yeah, no, that was kind of the reputation / stigma that FHA got before. And then earlier this year, Fannie and Freddie made adjustments to their programs, making loan level price adjustments a lot harsher for clients who don't have really fantastic credit. And I'm actually working with an agent in our office who went under contract for a home and had this exact same talk with her yesterday. Scores were solid, but it was just wholeheartedly going to benefit them to go FHA. One, because FHA, so while Fannie and Freddie made the penalties a little bit more strict or harsher on conventional files, FHA went in the opposite direction, making it a little bit more balanced in their favor. So now what I'm actually seeing is, if you're, let's just use the scenario of putting 10% down. So if you put 10% down, even on a conventional file, you're going to have MI. Sure, that MI is going to fall off eventually when you get to the 20% mark. But the MI for someone that has a 740 FICO is actually going to be cheaper on an FHA file right now. And their rates are a ton better too. That's another thing. And the reason why I present it to clients right now is because the fact that you will be able to refinance, and you should refinance. If you plan to stay in this home for a while, you should plan to refinance and go to a much lower rate once we get there. And whenever we do get there, that could be the option to transferring over to a conventional file if you've gotten 20% equity into that home. It's always a little bit tougher if you are putting 20 to 25% down and if you don't have MI, then it's better to maybe still present it's definitely going to be better to present the conventional option. But because of the changes that FHA has made this year and the stricter penalties that Fannie and Freddie have made on the conventional products, FHA has been a better option for a ton of clients. And the narrative is changing slowly. It's just gonna take time. FHA still has a little bit of that stigma of like, oh, why are we having to go FHA? What's kind of holding you back from going conventional? And more often than not, at least what I'm seeing on my end, is there's not really anything holding someone back from going conventional. But if I'm looking out for the buyer's best needs, the likelihood is that FHA could be a slightly better option for them. Hopefully, I hope that answers your question, Susan. Sorry.
Yeah, thank you so much.
Okay, Carly, you've got your hand raised.
Hey, yeah. So I've actually never written an offer with an FHA loan before.
Mhm.
The contingencies and the timeline for closing, is it similar to a conventional, or is that still something that kind of might make it so the seller is like, hey, I don't really want to string it along as long?
Yeah, no, fantastic question, Carly. So there are no appraisal contingencies on FHA loans. That's one thing to notate. And so, getting to like the finer details, that we can definitely dive into that. So there's no appraisal contingencies for FHA. For me particularly at Highland Mortgage, I'm closing FHA loans just as quickly as I am conventional loans. Definitely no issues at all. The one thing that I will just kind of say is possibly for conventional loans, sometimes you can get an appraisal waiver. Like I recently got an appraisal waiver for a client of mine, and that was the reason why we went that's the reason why we went conventional, because FHA, you have to get an appraisal done no matter what. So we went conventional instead. But more often than not, you're not going to get an appraisal waiver unless you're putting 20% down or around there anyways. So it was going to be better for him to probably go conventional anyways, because there's not going to be any mortgage insurance. But in terms of turn times, we are closing FHA loans just as fast. One thing that I would just say, Carly, is if you ever have like a self-employed client or something like that, definitely confirm with your lender or whomever you're working with if FHA is really going to be the better route, because they are a little bit more strict in terms of guidelines for self-employed. But if you're kind of your state-of-the-art straight W-2 client, we're closing FHA loans just as fast.
Thank you.
Question, Krishen. What is the narrative on VA buyers who have excellent credit?
On VA?
Yes.
Like on straight VA loans?
Yes.
VA loans are fantastic. I absolutely love VA loans. It's something that I'm actually very proud about. Not only do I think our servicemen and women deserve it, but interest rates for VA loans are fantastic. There is no MI. You can go 100% financing, which is fantastic, and there is zero MI at all. And of course, the likelihood is that because you're going at 100% financing and possibly getting some seller pay concessions, you may not have to bring anything to the table. So anytime there is a VA loan going around, I definitely take them that route rather than going conventional or something like that. I hope that helps answer your question.
It does. What is Highland's current VA rate, if I may ask?
Yeah, so it's still dependent upon credit scores, right? So
750 credit score.
Yeah, so you're going to probably be in like the low to mid sixes if you have great credit for VA. Another big benefit to that is there's just no MI included. So VA loans are always very, very strong if you can qualify that way. But that's kind of where we are right now. And definitely keep in touch with us and let us. I'll be able to kind of let you know where rates are pretty much day in and day out. A ton of volatility these days. So hopefully we are getting closer to low sixes, upper fives as we move along throughout the year.
Thank you.
Tom, so there's a couple of questions in the chat here, so I'm just going to read them out while we have a quick moment. So Barbara asks, how much is origination fee on a home over 450? So great question, Barbara. So it's generally going to be, you can quote however much origination you really want. What I generally do is I give, let's just say, on a standard strong client, I give 4 options, right? I will give them 2 conventional options, one with 1 origination point and 0 points, and then the same thing for FHA. 1 origination point is equal to 1% of your loan amount. So if you're at $450,000 purchase price and you're putting 10% down, that means your loan amount is $405,000. That means your origination point is going to be $4,050. I hope that that kind of answers, but it's always going to be 1% of your loan amount is your origination fee.
Okay, thank you for asking. So if someone is charging 3%, would you say that is very high?
Yes, that's extremely excessive.
Yeah, me too. Okay, thank you.
Yeah, that's in your case that you've put in the chat, that's $12,000 in just origination fees, not even including state of Georgia attorney fees, et cetera.
Correct.
I would never advise a client paying that much. That's pretty excessive.
Okay, thank you.
Yeah, no, you're welcome. Vicky had she wanted me to clarify there's not an appraisal contingency in FHA, so there's just no deadline. That's pretty much correct. Yeah, there's no deadline on getting an appraisal. The reason is we have to get an FHA case number done for the client, and we can't actually, by law, order an FHA case number until the client has signed certain FHA disclosures. So once they sign those FHA disclosures, we can get a case number ordered, and the case number and the contract is then sent to the appraiser to get the report done. And an appraiser actually has to be FHA certified too. So yes, so to answer your question, there is not theoretically a deadline. However, what I do is still get an appraisal done pretty quickly, and I will stay in constant communication with the buyer's agent to make sure I'm getting it during a time that's appropriate for them, or I'm not kind of waiting around too long or ordering it too soon type thing. So it's just staying in communication with the folks you're working with. And Barbara, you had a question about the also please explain the appraisal waiver and why someone would or would not benefit from doing so. Great question. So in most cases, I have noticed if you get an appraisal waiver, you're going to accept it. That pretty much means an appraisal waiver means that there is enough evidence in the market to support the value that the home is being sold at. So Fannie and Freddie, if a home is being sold at $450, and let's just say that home is in the Virginia Highlands and great area and all that stuff, there is enough supporting evidence and documentation out there and for public record to support the home being sold at $450, which would entail that our automated underwriting findings are saying, yeah, we don't need to get an appraisal done at this price point. We believe that the home is worth that much, and it's not a necessity to get an appraisal done. Now, you can get an appraisal done, and some people will want that. They want to see what the true value of the home is. So hypothetically, if you get an appraisal done, you're like, no, I want to see what the home is actually worth. If it comes in higher, I want to know what that figure is. you can do that. Just know that it obviously comes with the cost, a fee, and we have to, once an appraisal is ordered, we actually have to use it. So if we order an appraisal and then a week later you're like, nah, actually, yeah, I don't want to do it, I want to just go with the waiver. Well, we can't really do that. We have to use, we have to get the appraisal done now and use the figure, the value of the appraisal. So that would really be the only reason why I think someone would want to get one done, just to see the true value of their home. But it's also something that you can do outside of closing too. You can get an appraisal done on your house anytime that you want. And so that's what I would probably recommend if my client asked to get one done when we had a waiver. I hope that answers.
Hey, Sarah has her hand raised. Sarah?
Yeah, so for just to kind of elaborate on what you just stated, is that something that we would discuss with our clients, or is that something like if you were our lender, we would refer them to you so you can further elaborate the pros and cons on the waiver?
Yeah. It's something I actually have, like an email signature that I get, when it was refinance season, which just seems like an eternity ago, we were getting a ton of appraisal waivers. So I actually have a pretty detailed signature that I like to send to my clients once we get an appraisal waiver. Then I always will contact them and kind of share the pros and cons of it. And it's getting an appraisal waiver, especially on a purchase, is huge right now. Not only are you going to save yourself, a $500 to $600 fee, you're also you're really kind of expediting the process of the file, especially if it's a rush loan and you went in with competitive offers and things like that. You're really, as I'm sure a ton of you are aware on the call, that the appraisal is really just the most important factor when it comes to a transaction. It can really make or break a deal. And so if you get a waiver, it's huge. And I generally will explain that to both the agent and the client, the benefits of using it.
Okay, perfect. Thank you so much.
Yeah, no, you're welcome. Well, yeah, that kind of, at least for my sakes, kind of goes into the FHA and conventional pros and cons. But the kind of the summary there is definitely just staying communication with whoever you are working with, and get them to what I will always do is, even if I explain to a client, hey, FHA is really just going to benefit you, I still provide the conventional options to them, and then I include a comparison tab in my financing spreadsheet. That way they can click on the comparison tab, and I make personalized videos for my clients as well, so that they can watch my video and they can understand exactly how I'm going through the comparison with them. I'll be able to compare monthly payment differences, closing cost differences, cash to close differences, all that type of stuff, to where there hopefully shouldn't be any confusion. But I'm always a phone call or an email away if there are any other kind of hesitations there. So that is that kind of sums up FHA and conventional. Another great and fantastic program that Highland Mortgage has just rolled out is called the Dream Maker program. And now I get asked this a ton by agents, is, hey, what kind of DPA programs do you have, right? Down payment assistance programs. It's a constant thing, especially in this market right now, where the affordability for homes are going to be a lot less for the average American, right? And so we asked for down payment assistance programs. Here is just my personal take on down payment assistance programs. There are a handful of products out there that are really, really good, and then there are some that I just morally cannot get behind. And the reason is, and I'm not going to name the names of these down payment assistance programs, just in case that you are kind of quoting them to your clients. I'm not trying to bash any sort of program here, but there are a couple of programs where what they do is they give you free money, but the fees are a little bit predatory. So what they say is, we're going to give you down payment assistance, but the fees are going to be astronomically a lot higher than the product next to it. And also what they will do is they will restrict you from being able to refinance out of that product during a certain time period. One of the products that I know, there's a 24-month minimum period that you have to wait before the client is able to refinance out of it. And I just find that to be, pretty predatory there. And I don't like that. That's not something that I can morally get behind. So it's tough for me to actually want to, quote unquote, sell it to a client. And I don't think that what I'm doing is selling it to a client. I'm actually just trying to give them the best product that I think is going to work best for them and their family. And don't get me wrong, if that's the only product that is going to get this individual or their family into a home, of course, absolutely, I will do it. However, I rarely come into that situation where these programs that I'm referring to, the ones that have predatory fees and restrict you from being able to refinance should the market get a lot better. I rarely get into that situation where that's the only product they qualify for. One of the main products that I have loved that Highland Mortgage has just rolled out is called the Dream Maker program, and it's not just for first-time home buyers. It actually is only dependent upon the where your home is going to be located. Now, it's a Community Reinvestment Act. So Highland Mortgage is part of a Community Reinvestment Act where we are trying to give credits to folks that are purchasing in certain areas of the city or the surrounding areas of the city. So what we generally will do is if you're purchasing inside of this, we have almost like a heat map that I can send out as well. And if you're purchasing within that heat map, we allow for you can be the benefit of a much lower interest rate or $4,500 given towards your closing costs. And that's what we will do if your clients are purchasing within that specific area. So it's not based off of first-time home buyers at all. It can be really anyone, and it's not based off of income either. Anyone can qualify for this. It's just a matter of where the home is actually located within the city. And I'll just pause right there unless you guys kind of have any questions and I can also send out like a flyer to anyone who would like to get a little bit more information on it. And I'm also available via phone and email to chat about it in depth as well. Yep, Carly, I will send you the flyer. Absolutely.
Can you send the information to Tom? Tommy, can you send it to us?
Yeah, he can send it to me and I'll forward it to you guys, anybody who wants it.
I would like it as well. Thank you.
Yeah, absolutely. No, it's a product that it's great. It's a conventional product too. It's not like and it's just a part of a Community Reinvestment Act that we have partnered with Chase, and it's going really, really well. So I think that something like that is far better. And a couple of things about that program is it's a minimum 3% down payment. They are able to get much cheaper mortgage insurance, a cheaper interest rate, or either a cheaper interest rate or credits given towards their closing costs in the maximum amount of $4,500. And on top of that, the down payment, the 3% down payment can be covered via a gift, a 401k withdrawal, anything like that. So it certainly doesn't have to come from your own specific funds. It is great for first-time home buyers, but not limited to, and great for folks who are kind of just coming out of college and got their first job and wanting to go ahead and get their real estate portfolio started up. Yeah, Frederick, I will send it to you as well, man. And I guess I'll send it to Tom, and we can kind of forward it out. I'll be sure I provide my. Tom, do you think it's okay if I provide my contact information in the chat? That way, if anyone has any specific questions.
Why don't you provide the contact information and you guys just email him directly and he can send you what you need.
Sure. All right, that is my email and my phone number. So that is our one of the more or less major programs that I wanted to shout out to you all. Excuse me. Another thing that I am seeing in the market as well are folks who are looking to purchase a home, but want to purchase their new home and then sell their current home after they purchase their new home. So I have gotten a ton of questions over the past month or two, actually the majority of this year, about bridge loans and or recast payments. So if any of the agents have had their clients kind of ask them about this, it's really something that I see it kind of pop up a little bit more, definitely during the summertime as school gets out. You know, a lot of parents don't want to have to deal with selling a home and buying a home while dealing with, you know, screaming kids during the summertime all at once. It seems it's a nightmare to probably even say it, you know, let alone do it. So I have seen a ton of those types of inquiries come across, and we have a fantastic bridge loan at Highland Mortgage as well for your clients. What we do is it's a 90-day interest-only program, and we ask that the home is currently listed for sale, and we will go up to 80% to the value of the home minus what you currently owe on there. So if you have a $500,000 valued home, you owe $200,000 on it, well, then you can get a bridge loan of up to $200,000 on that home. So making your total loan to value $400,000 with your current mortgage being added onto there, and use that for the down payment of your new home. Of course, all of this is we just want to make sure that your clients qualify, of course. But your bridge loan is a 90-day interest only payment, and the likelihood is that you'll probably only have to make one, maybe two payments on that of interest only during the time that you are transitioning from purchasing your new home to selling your current home. So we have a bridge loan that has been super beneficial for some clients, and then I also get a ton of questions about recasts as well. And is it Carlin? Yeah, Carlin, you've had some recasting for your clients. Yeah, it's a great thing. What we do is we pair the clients up with certain investors that have really easy restrictions on recast. And for those of you who don't know what recasting is, pretty much if a client is purchasing a new home, and then they are selling their current home. And generally, if you sell a home, you know, and you've been living in that home for a while, let's just say you net an extra $150,000 in proceeds from that home, right? And what you're saying is, well, I don't want to just have all this cash in my checking or savings account. I want to put it towards my new home. Well, we can recast your payments over the life of the loan again. So if the loan amount for your new purchase is hypothetically $300,000, but you net $150,000 from the sale of your current home, we can take that and recast your payment over the life of the loan, significantly lowering down your monthly payment. And generally, the idea, the process behind that is there is a recast fee. It's usually no more than about $150. And then it takes a couple of weeks for the servicing team to go through that process. But they ask that you're making a one-time lump sum payment, you know, of $10,000 or more. And generally, if you're recasting, it's going to be more than that. And you will pretty much take your net proceeds and take however much you want from that net proceeds and put it towards your new loan amount for your new home, which will significantly lower down your monthly payment. And it kind of is just a better option rather than overall having to like refinance and stuff, pay fees and have an appraiser come back out to your house and things like that. A recast is a much simpler process.
That's awesome. Hey, I have a question for you. There's been a lot of discussion about people that have more money having to pay a higher interest rate. Can you address that a little bit?
Yeah. So definitely, that was kind of, as you might remember, what I was saying, the loan level price adjustments that Fannie and Freddie have implemented. So it's still cheaper for you to have. It's still the pricing adjustments that they've made are still beneficial for clients who have a lot more money to put down and have greater credit. They've made it a little bit more expensive for them. It's still going to benefit you to have great credit and put a lot more money down on your home. They have definitely made it more expensive and more costly for those types of clients. Whereas if let's just say if you had a 720 FICO and your loan level price adjustment was a half a point hit for having a 720 FICO, now they've made the penalties for those types of folks a little bit harsher. And what they're really trying to do is they're trying to kind of level the playing field for folks who maybe don't obviously earn as much income and maybe couldn't spend their lives taking care of their credit, and they kind of had to start with a lower credit income, with a lower credit score, and build that up. So they're trying to, help level the playing field a little bit. Those are definitely a ton of pushback, from multiple different entities on why they would penalize folks who have taken great care of their credit. And it definitely, I think the voices were heard, but it's just kind of trying to give folks with lower income / lower credit scores a bigger opportunity to win a home rather than folks who've had the ability to take care of themselves their entire life.
Agents, anybody else have questions? Krishen, is there anything else you wanted to discuss with us today?
I do. We do have, if there are any agents who have clients, this is really kind of like a luxury product. And this is just me throwing it out there because it's something that we rolled out at Highland Mortgage as well. And it's called an all-in-one mortgage. And this is really kind of a more complex product, and it's something that we offer. There's a ton of DPA programs, there's a ton of first-time home buyer programs. This is kind of your program for the folks who are purchasing their third and fourth home, who do obviously very well for themselves. And it's called an all-in-one mortgage. And pretty much what it is it's a 30-year mortgage. But once we identify that it's a 30-year mortgage, everything that we know about mortgages kind of needs to be dumped. And an all-in-one mortgage is an interest-only mortgage that comes with an associated checking account. And each and every day, that checking account and that balance of that mortgage is swept against each other, and you just pay interest on the difference. And what that means is, let's just say your mortgage is $500,000, right? That's your loan balance for your mortgage. But in this associated checking account, you have $200,000 in there. That checking account gets swept against the balance in that mortgage, and you pay interest on the difference. So you're actually paying interest on just $300,000. You're not paying interest on $500,000, which is how 30-year fixed mortgages generally work, right? And if you ever look at like an amortization schedule, or you look at your mortgage statement, for example, you'll notice that interest is all front loaded. And it's been like that since the Great Depression, right? Since 30-year fixed mortgage came out was in it was like the late 30s or something, kind of during that Great Depression era. Interest is very, very front loaded and principal is back loaded. So you'll notice that on your mortgage statements, most of your payments, especially if you're in your first 3 to 5 years, most of your payments going towards interest. This is a much different type of product, right? Is your rate going to be higher for the all-in-one? Yes, but it's not about rate. It's about how much money you are able to save on interest, because you're actually only paying interest on what you owe, not what your actual loan balance is. So hypothetically, right, the first question that I always get was, well, let's just say my loan balance is 200,000 and I have 200,000 in that associated checking account. Well, then you have no mortgage payment because it's swept against each other. So you have zero balance because your checking account and that loan balance are equal to each other. So that is one fantastic product, and you can still use that associated checking account for bill pay, for using it for groceries, all that type of stuff. But each and every day, the balance of that account is swept against your loan balance, and then at the end of 30 days, at the end of the month, your interest only payment is calculated based off of the balance given every single night at midnight. Pretty complex product, but it is actually pretty spectacular. And the company that started doing this, they started doing it about a good 20 years ago. And of course, you didn't really hear too much about it because it's not your traditional financing. And then of course, when rates went to 2 and 3%, you're probably not gonna go for this. You're gonna go for a fixed product that has a 2 or 3% interest rate. But when rates went to the 6s and the 7s, this really started coming about. And I'll tell you a quick kind of cool story. Is my CEO did a loan for one of the Atlanta Braves players, and while I don't know about anyone else here, but the Atlanta Braves players, they're obviously making millions and millions of dollars, but it actually saved him a ton of money while not having to actually fork out so much of his own money. He simply just did an all-in-one mortgage and transferred. I think he bought a $1.5 million house, and he just transferred that money into an associated checking account to where he really doesn't have a mortgage to pay, and it saved him a considerable amount of money, not having to pay interest on that.
What is an associated checking account?
So it's essentially just like a checking account, just like how we all have, right? But instead of you having a checking account you can still have your own checking account, but you're going to have a checking account with this investor that does the all-in-one mortgage, and it's called CMG. And so, but the checking account is used just like anything else. You can use it to pay your credit cards. You can use it for bill pay, groceries, gas, all that type of stuff. So it's essentially just treated just like anything else. It's just each and every day it gets swept against your loan balance as well. And then you're just making an interest only payment. You can make a principal payment too towards this mortgage, but you're just not obligated to.
So it sounds like in that program, to me, if I were to do a program like that, I would open up that account and basically not use it and just keep making deposits into it. It's going to help me with my interest rate down the road.
That is correct. Yeah. And what I actually did, this was back in January of this year. I taught a class here at the Metro Atlanta office in the training room on this product. And, it definitely is, it's a head turner. That's for sure. Now finding the correct client for it that's where it can get a little tricky. I've done a couple of these before, and it's really, really good because the great thing about this is, let's just say like a home equity line of credit, for example, right? If you want to go get a home equity line of credit, you have to go and apply for that and get an appraisal done. With this, you can, if your balance of your mortgage was $500,000, but then you've kind of slowly paid it down to $300,000, you can just go into your loan balance and withdraw the amount of money that your loan was initially at and just transfer it into your checking account. And your payment still stays the same because it's transferring it into the checking account, but your checking account's rising and your loan balance is also rising, but it's netting the same, if that makes sense. Wow. So yeah, it's a really, really brilliant product. It's a little complex, but once you kind of get your mind wrapped around it, it is absolutely fantastic. And I actually had someone do it for a second home. They're purchasing a beach house, and it really worked well and wonders for them. And there's a great, if you go onto the CMG website, which I could kind of send out a video of me going through it, I'll be able to kind of break down the savings that one can have between the all-in-one product and a traditional 30-year fixed product, especially
Wow.
where rates are right now.
Carly has a question.
Yeah.
Can someone refinance into this type of mortgage, or you need to be starting with this? Oh, you can.
No, you
Okay.
can refinance into it. Yeah, no, fantastic question. You can refinance into it, and minimum down payment is 10% on purchases, or minimum ownership on refinances is 10%. They actually go a little bit higher than the conforming conventional loan amounts too. So they actually go up to 850, I believe, or 800,000. Whereas if conforming conventionals stop at 726,200. So, but yeah, no, it is a really, really good product. It does take, I will say the average client that probably qualifies for this should have some savings and should have a decent, monthly income coming in as well. But I think everyone kind of will have those types of clients every now and again where this product will really benefit them. And most folks don't know anything about it either. So once you do kind of explain this to a client, they're really kind of taken aback and appreciative that there is an alternate option, other than the 30-year standard fixed mortgage, which just, it's been around for almost 100 years now. So,
yeah. Mika has a call or has her hand up.
Hi, Mika.
Hi, thank you so much. So I just received a message on social media. I put a post up about delinquencies and bankruptcies and all. I have someone who has student loans that are in delinquency and they're starting the bankruptcy process. How should I guide them with knowing that they're in this process to help them to obtain a loan? What should I advise them as to what to do next?
Mm-hmm. Yeah. So conventional guidelines on bankruptcies are pretty strict. There is a big waiting period. I want to say it's 4 years for bankruptcies, and then for FHA, I think it's just 2 years for that. So bankruptcy can take a while, and the recording date is what we go off of, the date that it's actually completed by. And then from there, they're unfortunately kind of in a waiting period. There are a couple of like non-QMs loans that you can do that don't really take bankruptcies or things like that into account. Again, something I really can't morally get behind. You're talking about your rate just being outrageously high, because that's when a client is given an only option, they're gonna hit you pretty hard with rate and fees. My best advice for them would be to get the bankruptcy taken care of and just go through the waiting period. And I'll have to double check, Mika, but I'm pretty sure for bankruptcy on FHA, it's a 2-year waiting period. I think foreclosures is 4 years. I always get those two mixed up. But if they do that and it's only a 2-year waiting period, then they could start the whole process up again, about 18 months down the road, and try and go ahead and start making sure they have their ducks in a row by the time they hit that 2-year waiting period.
Yeah, unfortunately, it's things that people are starting to do now to recover. So I'm starting to get more and more questions about bankruptcies, helping people get out of foreclosures and things of this sort. So.
Yeah, I assume that stuff's going to start really kind of ramping up now with just where the economy is, and having, like you said, with student loans, having to be mandatorily paid back here starting again in like inside of 90 days. It's going to be interesting the way companies like to kind of charge clients on that, and after not having to be paid for 3.5 years.
Thank you so much.
Yeah, you're welcome.
Okay, guys, it is actually 12:59. So Krishen, thank you so much.
You're welcome.
You did a fantastic job. Great knowledge. I'm glad you all who took the time to be here today. We're here. Hopefully you got some great information to pass along to your clients and afford you to write better contracts. That's the whole purpose. And if there aren't any more questions, I will adjourn the meeting. Our next broker chat call is, bear with me while I pull up my calendar, is going to be on the 26th of June. So Deborah Blue from the managing broker at the Keller Williams Midtown office will be heading up that call. And again, if you all ever have any suggestions, please let us know. We're running out of topics. So we would love your suggestion if you have any about what you'd like to hear from us. All right. So Mika, do you have another question? Yes,
Mika, I think you're.
Right.
No,
you're
sir. I
muted.
just didn't let my hand down.
All right. No worries. Just wanted to make sure you were heard.
Carly, you might have.
I do. Okay, so Tom, real quick, I wanted to ask you, I have seen this at several different price points where a listing the price will actually increase. When do you recommend actually doing that for a listing? Does my question make sense?
Are you talking to me?
I am talking to you. Yes.
Oh, okay. What is your question again?
So I've seen different listings at a variety of different price points over time, sometimes increase the price of the listing. A lot of times it doesn't seem to make sense, especially from like a buyer's perspective. When do you recommend that actually does make sense for someone to do?
Gosh, that's an interesting question because I haven't heard that question before. The only thing I can think of is that if they have, if a buyer, before it's gone to active or active under contract, outbids somebody and pays more than the list price, the listing agent might, in that case, want to up the price for appraisal purposes. But that's the only reason I can think of that it would make sense, because if you've got a house and it hasn't sold, raising the price isn't going to help you. But my guess is they're doing that for appraisal purposes.
Okay. Okay. Thank you.
You're welcome. All right, guys. Y'all have a great day. Have a great week, an award-winning week, and I will see you very soon. Thanks for joining us.